Hi friends, this is Bank Nifty 5-minute chart on 11th January 2023. In all the videos so far, we have been discussing when to trade. In this video, we will discuss when not to trade because it is equally important to know when not to enter the market. So last 2 days price has been falling very steeply, and from this point all the game has changed. Let me draw a vectors between the minor flows that have been displayed the last 2 days and show you the price signature how it has been for yesterday and today in a very minor flow dimension. I'm not talking about major flow, I'm only talking about minor flow as of now. Minor flow means flows within the major flow. So this is the price signature, and if you want to trade such signature, it's practically impossible because we are looking out for price vectors which are smooth in nature, which are not so aggressive, at the same time not so less aggressive. Okay, we want some kind of moderate wave vectors, something like this, a wave vector like this. But this is a too impulse of a trade to enter and exit because we don't know where price is going to take a reversal, and if you are not following proper risk management techniques, there are good chances that you may trigger a stop loss with pretty good loss. So this is called Brownian motion. Brownian motion is when you don't know what is next high and next low. If you are asking that if you are going to open a trade here, there should be a proper logic and reason to enter a trade. However, looking at the price chart here, you are saying that you can see that the buyers from this zone are not able to break over this high. Sellers from this high. They just only poked 1, 2, 3, 4, 5 and then price reversed. So they failed to close above this level, which means this is a fake structure. Until or unless you have some credible information that this is going to be a market edge, only then you could open up a trade when price again touches its frequency like this. Okay, otherwise it's unpredictable and it's not realistic to enter such trades. Now, price will always show something which is unimaginable, and that has happened with this steep spike. So if you're trading the steep spike, I'm sure for the first two candles you might be thinking that market is falling, but the next three candles has totally tilted the market, and many might have triggered stop loss. And when price is very wavering like this, then I'm sure many people might have got some profits, but very quickly they might have got evaporated into losses also. So to have a proper trade, we need to have proper price signature. Let me show you another example where you can properly trade and enter markets with pretty good risk reward ratio. Okay, here I'm talking about major and minor flows both. Okay, so this is the major flow and this is the major flow, and these are the minor flows within. Okay, you can draw many minor flows. It all depends upon your subjective interpretation of market, like which one is minor and which one is major. Okay, so in this case both major and minor flows are in traveling motion, which means both are predictable. So these are the kind of trades you generally have to look for. Okay, I will draw a minor flow in red vector. Okay, and I'm going to uh, delete the price now. Look at this vector, how beautiful it is. The major flow, which is in blue color, is creating higher highs and higher lows steadily. And the minor flow is also creating lower lows and lower highs steadily. This is the kind of uh, market you should look for ideally to have a proper logical trade. Now, let me show you how this could be a valid trade with some line work as well, with some line work and context also. So both line work and context should give you a proper logic and reason, only then you have to enter a trade. For example, let me take this low for example. Okay, so this low can be a market edge. I'll show you why and when. Why with the help of context and line work. So this is the inward frequency of the major flow upward, which has broken over all the other highs. So this could be a potential entry point for long calls. Though the textbook entry for such flows is actually here, the inward frequency, but since there's a flow shift happening upward, so this high can also be considered as a solid inward frequency. Now with that note, let us draw some line work and see if this could be another possible entry which is aligning to our context. If I draw a modified skiff pitchfork between the latest highs and lows, okay, now you see that the price is almost hitting the midline of this pitchfork and then creating reversals. So this is how, when both context and line work go hand in hand, and that will give rise to some fantastic trade opportunities. But today it has not been so in real domain. Though it is possible, I am not saying it is impossible to capture this edge. It is possible to capture this edge with some line work. For example, if I draw a line here with the latest highs and then place it back at the latest low or beginning of this vector, okay, we were expecting that the price will touch this zone and then bounce back. However, price did not touch that zone and then bounce back very immediately. The reason being that instead of taking this low, price has taken the previous next low as a major reversal point. Price touched that line and then bounced back immediately. So this is the kind of subtleties that we have to observe in price before taking any action. Okay, so if you are taking a long position here with the very touch of this candle, your stop loss should be very low of this candle. But in the real time, it's very difficult to anticipate price when such moments are happening. So today, the kind of manipulation done with market makers is kind of bear trap. So they push market aggressively with two strong bearish candles here, and immediately there is a price reversal. So this is kind of bear trap manipulation. When such bear trap manipulation happens, we need to wait for proper price signature, as I was referring to, like for example a solid structure or a frequency point. I'll draw some lines and show you how that lines can be worked upon if you are working closely to base if at all you want to enter such trades. So this is one line wherein I can draw touching all the highs, and I draw another line which is invisible to a normal retail trader. This line, okay, I'm talking about this line. Why this line I have drawn, I'll explain later, but this is very important line. I'll show you why and how. Okay, let me put it in blue color. Now this line, if I place it at the bottom low of this vector, price is catching some two beautiful edges. Should we trade based on this? Very risky, because you need to have proper context. There is no any standard inward frequency or demand zone wherein price can capture this edge. If you are a Fibonacci trader, you could have possibly entered a trade here based on your 50% Fibonacci retracement here, exactly at this point. But even that is not completely aligned with the context. So taking such trade ideas, shorting here and going long here are a bit risky without if you don't have proper context. So this is my observation, that if you are going to learn how to read the price, you need to find some optimal points where price takes specific or price gives specific signature that I'm going to reverse here, and this is where you can enter and this is where you can exit. So that's what makes a difference between a professional trader and a normal rookie trader. So this is what I want to teach you in this video, guys. So keep subscribing to my channel and watching my videos to have knowledge about how to read price like a professional. See you, and please also let me know if you are looking to get trained about how to read price using price action strategy, and I could be of great help to you. Thank you. See you in another video. Bye bye.